Klarna has this model where when they expand into a new country, their loss rates go up, right? And what they say is, this is part of our formula for growth and for expansion. Our model is we go into a market and we use this sort of short-term, low-dollar structure of pay in four to basically do a mass experiment on consumers in that market to sort out goods from bads, right? And so we give everyone a $200 loan to buy a pair of tennis shoes, and then we find out which ones will pay us back and which ones won't. And we don't really care how that's correlated with their credit score, their history of using credit. We sort of build our own model of good payment performance in this country. And then, what it does tend to happen usually is that their loss rates go down, right? Because they don't continue to make loans to the customers who aren't paying them back, but they do make loans to the customers that do pay them back, even ones who have low FICO scores or who don't have access to traditional credit products. That's a competitive asset, right? They don't want to give that data to the rest of the market. I think the way Klarna looks at it is, we know who the diamonds in the rough are that we can lend money to and help merchants sell their products to. We don't want to give that insight away to credit card issuers. We don't want to give that insight away to JP Morgan Chase. And if we furnish data to the credit bureaus, that's exactly what we're doing. And so I actually think it's entirely possible we might see pay in four providers sort of work together to come up with a different model where it's more like, hey, how do we have some kind of consortium or data sharing to stop like flagrant loan stacking, to stop first party fraud, to stop people who abuse the pay in four ecosystem? But let's do that separately than just giving our data away to our competitors, which doesn't make a lot of sense to us.